Well, we begin with a focus on the markets as we always do. And in fact, of course, the market's taking a turn lower earlier today after the president did threaten more tariffs on the EU and Apple in particular. Joining me now with more on the markets is Russell Hackmann. He's president at Hackmann Wealth Partners, author of the book Wall Street is Not Your Friend. He has it here in studio. Russell, I gotta say, Wall Street is our friend. Why is it not your friend?
Well, I'm not sure it's the friend of the average investor in terms of, and I'm talking in general about the brokerage houses, the money managers, generally do a pretty good job of extracting value from investors. And a lot of what I'm talking about in the book, Wall Street is Not Your Friend, is just how to attack those high fees that can creep into portfolios, how to avoid some of the market volatility, keep Uncle Sam out of your pocket. And so Wall Street's been my friend because I've been on it for a long time. I was at big firms and now have my own firm. And we're just trying to help the average investor do better.
So it does sound, though, that you're still bullish on investing. Is that right?
Long term, of course. We take the Buffett approach. We don't know what the market's going to do today, tomorrow, the next day, 10 years, 15 years from now, it'll be higher. But if you look at these kind of almost like casino type moves that we've had this year, like down 15, 20% and then back up to break even, those kind of moves are almost designed to extract value from individual investors, in my view. And so we talk to people about how to avoid those.
What do you make of the market at these levels?
There's been a big bounce, right? And you've been talking about it, everyone's been talking about this pressure on treasury yields, like 4.5% 10-year. That's raising mortgage rates, credit card rates. And, that's the bond market reacting to, hey, we got $1.92 trillion deficits as far as the eye can see. And, that's concerning. There's obviously more tariff news and trade uncertainty. So we've had a pretty nice rally with a decent amount of uncertainty out there. So I think a little bit of caution is in order.
Interesting here. Now, of course, the president this morning threatening, as I mentioned earlier, new tariffs on the EU and Apple. We see the S&P 500 set to open down about 1.4%, and we've seen the European indices turn lower in the wake of this after what had been a very strong rally since those April lows. How are you advising clients, people that work with your firm, to navigate these day-to-day, what can be volatile reactions?
Generally what we advise, our average client is 55, 60 or up and in retirement. And it's generally about putting together plans that, in fact, where you can ignore this kind of volatility, right? Where we're making just long-term bets on where the markets are going to go, but we also don't have too much exposure to the stock market so that the amount of exposure is sustainable. And generally, it's try to ignore this noise. Like a lot of people, some of the smart people are out there saying, hey, look at the signal, not the noise, and we try to focus our investors on that.
Earnings season is winding down, companies mostly exceeding expectations. Federal Reserve rate cuts also in focus. Since you do take the long-term view, what is your positioning or perspective when it comes to where rates might be the sweet spot in this market?
Well, I read an article this morning that was saying, hey, if you've looked at the short-term interest rates, treasury bills, 3-6 months treasury bills have been ticking up in the last couple weeks to like 4.3% yield. We like investors to buy those as opposed to a 10-year bond at 4.5% that could lose value, right? The T-bill, of course, if rates go down. But right now the market is saying, hey, we're not sure how fast short-term interest rates are going to be going down, how quickly the Fed will be cutting.
And internationally, what's your perspective on international stocks?
I was sort of classically educated in the U.S. in terms of lots of international diversification recommended. But in our own practice, we've looked at history and said, hey, U.S. stocks almost always dominate because of the innovation of the U.S. market, because of the higher growth rates, et cetera. And we advise most individual investors to be almost entirely in the U.S.
Are IPOs something you pursue?
Not really. I think that stuff is a little bit speculative and can be fun to trade, a little like crypto, but not a core investing strategy.
Interesting. And as we head into the summer months, there is that famous saying, sell in May and go away. Do you anticipate that will have any impact this year?
It kind of depends what happens with like trade negotiations, and so there's a lot of swirling uncertainty there. But you do tend to get some pretty quiet summers. But one thing I've learned about being in the markets for 30 years is you just never know whether you're going to have a boring summer or you're going to be on the phone all day in August.
Yeah. So from a defensive standpoint, what do you think is the right posture there?
We like the idea of, especially that audience of pre-retirees and retirees, having not much more than 50% of their money in the stock market. The other money not being in the bond market, but being in areas that we call safe, meaning like a T-bill safe. It can't go down in value, really. There's certain principal protected investments that can't go down. We like a nice spread among those kinds of investments and not really being in the bond market.
Russell Hackmann, he's a president at Hackmann Wealth Partners and author of the book that he has right here on set, Wall Street is Not Your Friend, even though he is bullish on long-term investing. Russell, thank you.
Thank you, Kristen. Thank you.